What's up, family? This is your boy Ivan Hall, the Credit King. What is your credit utilization ratio? Your credit utilization ratio is a percentage that indicates how much of your available credit is presently being used. This is usually calculated for each of your credit cards and across all of your revolving credit lines. Because of how severely it affects your credit score, maintaining a low credit usage ratio across all of your credit cards should be a major goal. According to both major credit scoring models, FICO and VantageScore, the amount you owe in relation to your available credit accounts for around 30% of your score. Credit usage is the second most important component in your credit score, behind payment history. This can be a double-edged sword because it is likely the easiest thing to regulate in the near term but can swiftly diminish your score. Maintaining low balances with high credit limits demonstrates to lenders that you are a responsible borrower, which may boost your credit score and open the door to credit line expansions, better credit card and loan conditions, faster credit acceptance, and other benefits. If you have a significantly greater credit limit, high debt does not always imply disaster for issuers. A high utilization ratio, on the other hand, may make you appear to lenders as more of a danger, which can drop your credit score, make new credit applications harder, and even lead to credit limit reductions, which can further harm your score and utilization ratio. To get your credit usage ratio for each particular card, just divide your balance by your credit limit. Add together all of your revolving credit account balances and divide the amount by the sum of your credit limits to calculate your overall usage ratio. A $500 balance on a card with a $5,000 credit limit, for example, would result in a 10% credit usage rate on that card. If you have two more credit cards, one with a $2,000 load and the other with a $200 balance, both with $5,000 credit limits, your total credit usage is 18%. Any rate less than 30% is considered a healthy credit usage ratio, but there is no exact credit utilization level that would help or hinder your score. Instead, attempt to keep your balance and usage ratio as low as possible in order to improve your score. Reduce your debt or boost your available credit to reduce your credit usage ratio. Applying for a bigger credit limit or a new credit card will provide you more credit usage breathing room while also improving your credit score. If you're having difficulties paying off your bill, a balance transfer credit card can not only help you put interest at bay long enough to settle your amount, but it can also decrease your usage ratio by making more accessible credit available to you. For more credit tips, credit hacks, and credit repair secrets, subscribe to our YouTube channel or visit us online at thecreditking.com.